The reason why I'd like to focus on business surviving, a survival strategy over centuries, is because in times of crisis, the first entities that go down and cause this chain of events that lead to social crisis and political crisis, it's the fact that these businesses are failing. The failure rate during crisis, it's very, very high. And I looked like 30% of the people in the world are hired by large corporations. The other 70% are hired by small and medium companies. So it's exactly the small and medium companies that fail faster during a crisis. I thought that if we could solve the problem of making sure that businesses do survive and they don't have to fire all their employees, then we might solve somehow this social crisis. Because if you have less unemployment, then people are able to consume more, and you avoid this social crisis that you typically have during a financial downturn. Now, it's worth mentioning that my background is in business consulting. I've been advising financial services companies, primarily banks across Europe and most recently Middle East, to survive, to not just to survive, to thrive, to become more competitive, more profitable. And I am, let's say, intimately familiar with how C-level executives talk about strategies when it comes to these companies. And they do not think more than 5 to 10 years time horizon. So nobody really thinks about long-term survival of a company, strategizing for long-term. On the other hand, my personal hobby has been understanding money, the history of money, the business cycles, and how this kind of translates into wealth accumulation, wealth preservation. And it's been basically an obsession since I was 20. So knowing both of these worlds, I find it astonishing that despite the fact that there are so many viable strategies for securing generational legacy for individuals, there is effectively zero marketed strategies for ensuring business survivability over centuries. I would like to present today what I call a strategy for ensuring business anti-fragility. I call it the anti-fragile business legacy, just because it comes from Nassim Taleb, for the people who are familiar with his book, Antifragile. He describes anti-fragility as a strategy not just to survive chaos, but to thrive from chaos, so benefit from it, position to benefit. And this is the perfect definition of a good hedge, if you think about it, which is pretty much what I'm proposing here for the companies. And that's what we all do, is hedge, when we try to position our wealth, diversify the wealth in order to make sure that we're not overexposed to financial downturns. Before I start, I wanted to mention some of the underlying principles of my personal philosophy and what it's in this presentation. The first principle that I strongly believe in and I advocate is the principle of utility. I believe that if you want to be an entrepreneur and successful at the same time, the only way you can achieve this is to bring successful and consistent value to your end clients. So unless we cannot have a voluntary exchange, right? And I will never exchange my hard-earned money for your product and services as an entrepreneur unless I value that product and service more than the money I pay for it. Because this is how I gain something out of it, and the entrepreneur gains the margin that he makes from his business. So it's the principle of voluntary exchange. And I believe that if you're not a crony, if you're not closer to the money printing office and you want to deliver deep value to your customers, then this is the only way to be successful, to consistently do that over time. The second principle is that paper money is not wealth. And as far as my knowledge of history goes, all the government-issued currency has reached zero over time. And this time, I don't think it's any exception. Of course, I mainly refer to fiat money, paper money. But even if you go back to Roman emperors, they would dilute the amount of gold in the coins until they would be practically worthless. So you could make the same argument for any type of government-issued currency. The third principle is that hard money is real money, and the definition of hard money is money that does not lose its purchasing power over time. On the contrary, it gains in value. So it means that you can buy more with your money over time, which is exactly the opposite of what happens today. You buy a lot less with the money today. So what I would like to talk today is why businesses, wealth, and business cycles are tied together, and when they fail together. And the fundamental reason why I think this is happening. I also want to touch upon this secular turning point that has been very well documented, which pretty much says that every 100 years or so we have a huge shift in the financial system, and there is a new system emerging, just like Bretton Woods did for the U.S. dollar. We are supposed to witness another one of these events, and I'll just say what is my view on that and why I think it already started to transition to a new system, and how to position for it, basically. Okay, let's see how fast I can do that. If you are a business owner right now and you're thinking about chances of survival during a financial crisis, they're not good. Statistics say today that between 30 to 50% of the existing businesses fail within 5 years. And if you look at the US market alone, which is the most developed, arguably, market, right? There are about 30 million businesses there, and only 25% manage to stay alive more than 15 years. 60% of them have a failure rate of, they have a lifespan of less than 5 years. And that's business as usual. That doesn't account for any type of financial crisis, any 1930s type of financial depression. You could probably easily double these numbers if you think about it. So if we are to think of how do we secure secular business legacy, then we need to have a strategy as a business to secure survivability during these extreme cases, during these financial crises, right? So that means that you have to be in the top 20%, right? Every time I speak with my clients, my former banking clients, the first thing we would always talk about is, okay, how do I stay in the top? What would be my competitive advantages? And of course, we would talk about operational strategies, how I cut my costs, how I'm a magnet for talent, how I make my brand stand up, etc. All of these strategies are great, but for 5 to 10 years a term. But if you want to survive a crisis, the only way to do it is having access to capital. Now, when it comes to access to capital, I found these statistics recently and I thought it was shocking. There are 400 million companies globally. And according to my very generous estimation, less than 5% have efficient access to capital. By that, I mean that in the top 5%, there are the businesses who are listed in a stock exchange and they have an army of lawyers, and within 24 hours, they just file a paper with the Security Exchange Commission or whatever is the regulator in the respective market, and they raise capital from the stock, from the public markets, from the capital markets in matters of 2 to 3 days, right? Or if you are a wealthy individual like Rick Rule, Frank Justra, I don't know if these names ring a bell, but you just make a few phone calls and you call a few buddies and you raise capital. These are the 5% max, right? But the majority of the other businesses have a much harder time to access capital. And if you, as a student of economics, one of the first things I learned about the fiat system is that the further you are from the money, the less the money is going to be worth by the time you get it, right? So the bigger the gap of accessing the capital, the less that capital will be worth. You're at extreme disadvantage, to put it this way, versus the top 5%. And that's why they are so powerful. This picture here shows only the S&P 500 market capitalization currently. And it shows where the capital goes, right? It's the Magnificent Seven that have the majority of the capital, the attention, from the markets. And then it's everybody else. Now, this is S&P 500. S&P 500 means that you have 500 of the most powerful, strongest businesses in the US, accounting for 80% of the entire public market capitalization in the US. So we are talking about big companies, right? And this is the gap. Now try to extrapolate this gap to the 400 million companies. I mean, unless you're in Japan, in Denmark, in France, the big economies where you actually have capital markets, most of the people most of the businesses are not even listed on a public stock exchange. So the failure rate is, their access to capital is really not that good. I'll tell you another thing. The average lifespan of a medium to large company over the past 50 years, I looked at 50 years because this is the exact time that we've been definitively on a fiat standard, because 1971, President Nixon cut the dollar from gold standard. So the average lifespan is 30 to 35 years. That's and the fiat money average lifespan is 35 years as well. I mean, you could say it's a coincidence, right? But I don't think so, because I think that the fundamental problem is not the digital monopolies. That's a result of the problem. It's not even this uneven access to capital that I mentioned in the beginning. It is the fundamental problem is that we are trading on a hot potato system. That's the problem. Fiat money loses value in time. When you're approaching a crisis, usually the loss in value is more rampantly so. So the potato, the fiat money, becomes hotter. And you constantly need to throw it away to make sure you're not stuck with a hot potato, because otherwise you lose money, right? You lose money through inflation, directly and indirectly. So that's why there is a mantra amongst all of the entrepreneurs. You need to grow or die. And you have like this minimum growth rate annually, regardless that you've been very successful, you have surplus cash flows, and now you need to, you now have to reinvest it at a yield that surpasses the rate of depreciation of the underlying currency. And that works. During good times, that works because you have expansion. You have the business cycle, right, goes into expansion mode. There is a lot of appetite, risk, etc. The problem is when you go into a contraction mode and you need liquidity. That's the whole irony. During a crisis, as a company, all you have to survive is liquidity. But when you are approaching one of these 100 years financial turning points, when the currencies go down in value and some lose it completely, right? You've seen how many currencies don't exist today because of that. There are these two guys that I've read, and they are very good sources that they have it documented this 100-year cycle very, very well. It's called, the first one is the fourth turning. And they have shown for the Anglo-American history how for the last 500 years, we have a severe economic turnaround in terms of the power for the main empires, the ruling empires, and the global reserve currency. Everything changes. Not just the currency itself, but the fundamentals, how the system works. We are on a fiat standard for 100 years or so, right? Now, if we were to imagine how this financial system reset is going to look like, let's go to the last one. The last one was between 1920s and 1940s, and you had two world wars. You had, on the one hand, you had a depression in the US, which caused 7,000 banks to fail. If you had a business back then, and the next day, your bank is closed, 7,000 banks closed. How do you pay your employees? How do you start your production? Impossible. Then the other experiment was in Weimar Republic, which we all know. People ran away with a sack full of money to go and buy bread, and they had to do it fast enough because otherwise the sack of money would be worthless. And the unemployment rate was 50% in the Weimar Republic. So thousands of companies failed. 30% of the US GDP vanished in 1 year. So the bigger question is liquidity into what? Because we cannot talk about regular currencies, right? They lose value. We know that. And one of the points that Ray Dalio made in his book is that a lot of people look at the price of goods, but very few people look at the price of currencies. And this is a chart, a very recent chart of the major currencies priced in the US dollar. Now, if you had asked Chris McIntosh or any one of these, financial experts, what currency is the best that I should hold my liquidity 5 years ago, they would have said, well, all of them go down, but some of them less so than the others. And the US dollar is probably the safest because it's a global reserve currency. Well, 5 years later, guess what? The US dollar is the weakest compared to all of the other major currencies. So before I answer that question, I wanted to make another point. I've been obsessed and followed, these giants, Mark Faber, Ray Krool, Jim Rogers, maybe some of the name, Doug Casey, of course, and they've been predicting this fourth turning Doug Casey has been doing it since the 80s, okay? So hopefully we get another 20 years of free money and easy money, and none of this happens, but it will happen. Now, I wanted to stress the fact that everybody's kind of obsessed when it's going to happen. And I don't think that's the right question to ask. Because before the year 2000, the global debt was in the form of trillions of dollars. 2000 was tens of trillions, 62 to be precise. 2025 is hundreds of trillions. I mean, 20 years from now, we could talk quintillion of trillions or whatever, The system just grows more absurd by the day. It's not a matter of when, but it's not a matter of if, it's a matter of when the system goes down. And you don't want to wait until the last moment because it never happens overnight. It happens gradually. And I think the better question to ask is, what is the new system that's already positioned to replace the old one? And that's what Ron Paul said before I was born, probably. He said, hard money is hard, not because the government has issued a decree saying this is hard money. No, hard money is hard because people use it as such. Remember the principle at the beginning. Hard money is money that preserves purchasing power over time, right? And to prove the point, I used this tweet from Luke Gromen, which I very much respect, a very good guy. He called it the debasement rate since COVID. And he priced the NASDAQ index, the S&P 500 index, and home prices in US dollars, in gold, and in Bitcoin. And the results speak for themselves. I mean, the US dollar did exactly as expected, which is lose value relative to everything else, right? Everything else, it's more expensive in US dollar terms, right? Gold, this is in October, by the way. Gold is now way up now, but the point is that you see they are up very little in terms of gold, which means that gold is as valuable as it used to be. And I'll never forget this. 1 ounce of gold buys you today the same stuff that it bought you 2,000 years ago in the Roman times. Now, I cannot think of a better argument to say that gold is money, because it's been money for thousands of years. There is no question about it. And there is another question that Luke posed, and I liked it. Do you know how many currencies have survived gold over the past 2,000 years?
0.
Exactly. Is there any more proof? So gold is money. Now, Bitcoin is a new currency. Doesn't have enough, history and weight, but it's been designed to be deflationary. Right? It's only going to be 21 million Bitcoins. And I'm not a Bitcoin maxi. I definitely don't think Bitcoin should replace gold and will ever do that. Well, not now at least. But what I'm showing here is that it's done exactly as expected. Relative to everything else, Bitcoin is more valuable now than it used to be. And even with the recent crash, because for people that follow this, right, Bitcoin was 120,000 something per Bitcoin. Now it's 60, 70, 80,000. But in 2020, it was 7,000. Not to mention before, when it was traded for $1, right? So my point is that Bitcoin is a de facto deflationary asset, right? So it grows in value relative to everything else due to its embedded scarcity. So now, my theory about the new financial system. I believe that based on my knowledge of economic history, monetary history, every time we had a reset, the new power had to use a trust anchor into the new financial system. There are rumors now that the BRICS nations are working on a currency that is going to be backed by gold, right? I don't know if that's true, but what I think is that gold has been, because gold is money, right, and everybody recognizes it as such for thousands of years, gold will have a key role in the new financial system. So, non-dollar system. However, we are not going back to trading physical currency. I'm not going to buy, bread with a gram of gold. That's not going to happen. It's going to be digital money. We are going to have some sort of a tokenized value backed by Bitcoin at the beginning, just like the dollar was, Bretton Woods made the dollar the US, the global reserve currency because it was as good as gold. It was redeemable into gold. This is what they will do with the new system, but it's going to be a digital token this time, in my opinion, right? So now back to the original question. If you are an individual and you have a legacy that you want to keep for generations, the easiest thing you can do is just buy some gold. Just buy some gold and hold it, never sell it. Because there is bear market in gold, but over time, over generations, gold preserves its value. But if you are a business, most of your wealth is going to be transacting with other businesses. So you have to be in the system to trade, right? You have to be in this token-based system. Even if the system is backed by gold, the problem with gold in the digital world is that it loses the primary advantage as hard money, which is counterparty risk. You need to, when I exchange something with you and I give you a token, a backed token of gold, right? I have to trust, both of us, we have to trust a third-party vault to make good delivery on that gold, because unless I have it physical, then gold doesn't exist. So there is this deep vulnerability in the fact that you don't have instant, you no longer have the zero counterparty risk that gold has. And Bitcoin, as far as I know, is the only currency with counterparty risk. And I believe that the majors are going into these two assets because of these reasons. And I'll just look at the majors. These two assets, gold and Bitcoin, and they do it with their corporations, not at an individual level. They build a separate corporate entity meant just to hold directly in direct custody gold and Bitcoin. I'll go quickly through these slides. Tether. Who heard of Tether? Okay, good. Tether is the largest stable currency, okay, in the world. It's responsible for 70% of all the digital currency settlement in the entire world. Now, before I said that the system will be digital, right? So if you think the system will be digital and you see what Tether is doing and how they are positioned, they will be a big player in the future system, no doubt about it, in my mind. Here's what they do. They announced that they have deployed $8.7 billion in direct ownership of gold in the Swiss vaults. 8.7. That was as of November 2025. As of January 2026, so just a few months later, they have 17 billion worth of gold. So they keep acquiring. Of course, the price of gold also increased. The CEO said that they meant to allocate 15% of their holdings to gold. Now, just to explain a bit, Tether is supposed to be on a one-to-one basis with the US dollar, right? One-to-one relationship. So one Tether equals $1. To make this happen, they are the net buyers of US Treasury bonds. And they hold like $145 billion worth of US Treasury, so government debt from the US, right? They are in the top 10 next to central governments like Germany and France that hold most of the US debt. So if you have any doubts that Tether is an important player in the future system, I think this should kind of clarify that they are not. The other thing they did is they made a gold treasury company. So it's a company this time that's listed on a stock exchange. For people that understand how gold ETF works, this is just another type of gold ETF, but this time it's based on a blockchain. So the advantage with this one is that you can actually track the inventory of gold that they have through the blockchain, as opposed to just trusting them, which solves some problems for gold, which shows how gold is going to be tokenized, right? Because this is exactly what they've done here. They tokenized gold. What they've also done is they funded the third largest Bitcoin treasury company. They are the largest shareholder of 21 that have in their treasury right now about 40,000 Bitcoins that's funded by the shareholders, and they plan to get financing in order to buy a lot more. And And they also are the second largest owner of Bitcoin, of private Bitcoin. So not listed on a stock exchange. They just have a private entity only holding Bitcoin, and it's 96,184 Bitcoins as of now. So it's a lot of money, right? They are very well positioned in both of these markets, gold and Bitcoin. Another very interesting aspect, there are 360-ish companies, governments, public institutions that hold at this moment 4.1 million Bitcoins. If you make 4.1 million Bitcoins divided to 21 million, the total amount that will ever exist in Bitcoin, they are responsible for almost 20%. A handful of companies are holding almost 20% of the entire Bitcoin, and they are positioned to acquire a lot more. Now, initially, when I talked about this, I thought, you know, for the fact that we have a paper market, we have a derivatives market, and these big players piling into Bitcoin, this will mean that Bitcoin volatility will decrease. And what happened is exactly the opposite. And then I realized that what happens in the Bitcoin market is exactly what happens in the silver market. The big traders, and maybe Mads can understand this a little bit better because you were a trader, right? But what happens in the paper market, it's not exchanged physically in the physical market, but it does influence the price. So they can influence the buys and sells, and they crash the price because they want to buy cheap. And there are 200 public companies currently that are positioned for exactly this thing, to acquire Bitcoin. Some of them, they do it only as it's their entire business ecos to acquire Bitcoin, but some of them are coal miners in the US. One of the largest coal miners in the US, they're not really, you know, ecstatic about it. They don't talk about Bitcoin, no, but they have a treasury of Bitcoin. And they write in their annual reports, if you read their management discussion and analysis, they say that, yes, we have a treasury, that we keep it strategically in order to hedge our business. And they have a hard asset, right? It's coal mine. And they have also a lot of royalties in the Permian Basin. So we are talking about a company that is pretty well set for a crisis because they have hard asset. But they also have Bitcoin. And I think if they had some gold, they would be, you know, well set for life. Governments also have exposure, but not so much. And, you know, the thing is that most of the governments, the US, the United States as well, and China as well, they do not mine their Bitcoin. They just confiscate it. So, you know, they don't have to acquire Bitcoin as they have to acquire gold in this case, you know, the central governments. All they have to do is find a way to tax it or find a way to make you guilty for some fraud that you've done, and then they get your Bitcoin, and that's it. That's how they get exposure to Bitcoin, and they've done it, you know, so it happens. My point is that what I've described so far, it's not just positioning for capital appreciation for Bitcoin and for gold, which they are appreciating over time, and particularly Bitcoin. I think this is the start of a new system, and hence my reasoning that it is important to be positioned in both of these assets. And the best way is to learn from the big guys, to look what the big money is doing. And they are building a separate entity, a holding entity, which is very inexpensive in a safe haven jurisdiction. And all that entity does is hold. If they need liquidity, they will pledge very conservatively a portion of that holding to account for volatility in the underlying prices. And they get, let's say, a loan 5-to-1 from the worth of that treasury. And that's how they get liquidity, pay no taxes, just like Pavel mentioned before, and deploy it to whatever other opportunities they have. Most importantly, imagine if enough businesses would do that. I mean, if you have a sufficient mass of businesses that would acquire some gold, and some Bitcoin, if they're not anti-Bitcoin, because some people are really skeptical about it, so, you know, you cannot help it, the failure rate would go significantly down. The unemployment, firing people would be reduced because they wouldn't have to if they don't go bankrupt. And probably the boom and bust cycle that we've had would be less intense than it's usually the case, you know. And I know it might sound naive. A friend recently reminded me that the world is not meant to be changed, it's just to be lived and learned from it. So, you know, I don't know if that will be pulled through, but that's a pretty good aspiration. But whether we have a system reset or not, having these two assets as a business is a great advantage because you profit from the underlying asset. This graph here shows the risk-adjusted return for a portfolio that has no Bitcoin, gray line, and some Bitcoin, which kind of puts into perspective how important it is to have a little bit, 5% allocation to Bitcoin, because it's so well positioned to thrive. The other thing is hedge against disruption, inflation, global debt, geopolitical instability. And Bitcoin is a risk asset. It tends to go up during good times. Gold is a safe haven asset. It goes up only when the fear barometer is very, very high. So when you have both of these, they're like a soulmate, you know, because they in the good times, you're not losing money because you gain from Bitcoin appreciation. In the bad times, even if Bitcoin price goes down, unless you sell it, you're not affected by that. And Bitcoin has the huge advantage that if you want to carry it across borders, nobody will know. You could have billions of dollars in your pocket in a small device, and you cannot do that with gold. So I think both of these have really substantial advantages to protect from a severe, from a black swan. And both of them are tradable 24/7, and you always find some counterparty who is willing to trade with you in gold and in Bitcoin. And you can do that. It's not difficult. It's a way to opt out from the system. There is one video that, I don't know how I do with time, by the way. There's a video that talks about the 100 Club, and this guy makes this pyramid with the social hierarchy of the wealth distribution. And if you put all the wealth in the world, and you have the top 1% richest and the very, very, very top 0.1% uber richest, and now you need to have a wealth in the forms of billions of dollars, right? If you put that in and you replace it with gold, we know that there are about 200,000 tons of gold that has ever been mined. If you make an association, the amount of gold that you have to own in such a system to be in the top 1% is just 100 ounces. 100 ounces of gold suffices to be in the very top levels of the echelons. You know, so it makes sense. If enough, now who owns all the gold? Because if you look at all the countries in the world and you sum up their official reserves of gold, it's like 20% of the entire gold that we know it exists. Who owns the other 80%? It's the elites, right? But if the central bank, the bankers and the private individuals, if that means a lot of power, a lot of concentrated power. But if enough businesses would own some of that gold, would buy it, then you dilute a lot of that power. So I think it's a great advantage. How to build a treasury? This is more technical. I don't know if anyone is interested, but I'll just go quickly through that. It's not difficult. You just need to understand what is the best allocation for your business. So if your business is technology, you might want to downsize the Bitcoin, for example. If your business is gold royalty mining, then you might not want gold because you already have exposure to gold, right? So you might want a plus on the Bitcoin. It's from this point of view. If any business would do that, would buy some gold, I think it's already a huge leap forward. But imagine if they made that part of their overarching company vision. If they would train their employees and tell them what hard money is and why gold is money. I mean, we could reach out to a lot more people through the businesses that train their employees on sound stuff as opposed to, corporate useless stuff. And of course, structure and jurisdiction is important. Operations, how do you get liquidity? Maintenance reporting. These are like business as usual. It's not difficult to do it. There are different types of structures. I won't talk about that, but I'm available to talk with anyone interested. The last thing I want to say is the what if. What if gold goes down? What if Bitcoin crashes? And I thought that this graph is really important, is really nice because it shows the black line is the gold price in terms of Weimar marks. It shows in a Weimar Republic, when we had hyperinflation, it shows you how many Weimar marks 2Q you needed to buy 1 ounce of gold. So it shows how much the Weimar mark depreciated, okay? The red swings is the volatility of gold during that time. My point is that gold tends to be a lot more volatile when the currency is close to its deathbed, to say so, you know, because it imploded, the Weimar mark, right? And people who are claiming now, you know, that, oh, we had 30% drop in gold and silver. Well, we might think about, well, if we are in these stages, then it's really bad, because look what's next, you know. So you might want to consider holding gold, not sell it. And this one it shows the gold as a percentage of the Federal Reserve balance sheet. I'll just quote these guys because I think that they've made a very good point. It says, they do not think that the Fed balance sheet should be 100% backed by gold. Right now, look where they are. Like 10, 11%, I don't know, right? So they don't think it should be 100% backed by gold, but the historical average is 30 to 50%. If we go back to 30, 50%, the implication is that gold price would mean to be anywhere between 8,000 and 12,000 per ounce. Now it's around 5,000. So to wrap this up, people say, well, what if Bitcoin is hacked by quantum computers and its value goes to zero? What if gold is mined from steroids and then, you know, the value is going to zero? Yes, there are people who make that argument. I know, it's crazy. But I'm thinking, you know, what if the US dollar loses the last 3%? And, you know, your wealth goes to zero? I think this is a higher probability and a higher what if to focus on than the two improbable ones. And that's it. Thank you very much.